Alright, so time to record a video. Now, I'm down a few episodes, I believe 3 as of now. So, I'll do 1, we'll see how that goes. If I have time, I'll do 2 and 3, try to make up for it due to moving in. Just got in college, so I got a new setup, desk. And today, we shall talk about taxes in regards to GDP. So, real quick refresher for those who haven't seen my other videos where I adjust GDP at least partially. C plus I plus G plus X minus IM equals Y slash GDP. Now, consumer spending is here. Investments here. Government spending here. And then these are exports and imports. Now, what do taxes play into this? Well, think about what a tax is. Let's take person A here, and he has an income of $500. If his income tax is, say, 30%, then that removes roughly $150 from him. So he can only spend, at max without taking out loans, $350. That $150 goes to the government, who then chooses how to spend it in their own budgeting and so on and so forth. Here's the thing. The government's already taken out loans. In fact, this spending is not financed by this, by and large. It's financed by debt. So, higher taxes does not mean increased government spending and lower consumer spending. What it actually means is higher tax resulting in lower C, consumer spending, and I, investments. The lower investments can possibly, I say possibly as in it's not a guaranteed exact, but it also possibly lower exports as well. This is because exports are driven by local investments and production. So if you are building less factories to produce goods, then you are naturally going to see, as a result, lower exports because consumer demand is rising, and simultaneously you're not increasing production, so you can't export as much. As a result, exports have a very real chance of going down. And so, if you lower tax, you raise lower tax, you raise consumer spending and investment, and again could possibly increase exports. It all depends on how well your investments do. Now, let's look at person A again. I'll draw a little A on our head so you know it's person A. Let's say the tax is reduced to 15% now. What are they doing now that they have an extra $75? Well, that depends on their character. They could save that money to use it later, or as a buffer, or they could spend that money. Now, spending directly helps C, and if it's an investment, I. But if they save that money, that's also good, because it means that money is likely going to a bank. And banks can give out loans based on that. These loans thus result in spending and thus contribute up here. So they could spend directly and boost GDP, or they could save their money, which will eventually result in someone spending somewhere and boost GDP. As well as that, by saving, person A is inherently reducing their risk, and thus making the economy stronger. And so, naturally, the GDP benefits from either action. This one I'd argue a bit more, as it makes the economy more stable, and thus your GDP isn't going to dump and rise and dive as quickly. But both are beneficial to some extent. Now then, what does that mean for the government? You decrease taxation, sure, and that means you're initially going to make less money, but think about it. More GDP correlates heavily to higher taxes. Now, it depends on how that tax is collected, of course, but income taxes, for example, benefit from more people getting paid more wages. Well, I'm just going to ignore that and go back to explaining. So, if you collect an income tax, this is true, because naturally, as people get more money to spend, they're going to spend it more, and thus businesses rake in more money, and so as competition goes up for jobs, so too do wages. Sales tax, of course, also benefits. So, GDP means up sales tax, up income tax, and as another bonus, up dividends tax. This one is more direct due to the fact that businesses make more money with lower taxes, so the dividends people generate from them will be higher and thus bring in more wealth. Property taxes are less guaranteed, and if it's an increase in housing supply, likely so, but beyond that, you're not certain of it. And of course, there are consumption taxes. So separate taxes besides sales based on consumption or purchasing of a specific good. For example, tobacco has a consumption tax associated with it. This is commonly called a sin tax because it's often done on sin things, so things people consider wrong to consume. Alcohol is one of them, marijuana, cigarettes, they all fall under the same. And does that rise? Also yes, meaning it is reasonable to say higher tax, so not higher tax, higher GDP equals higher taxes. And since let me keep this down real quick. Since higher taxes is generated from higher GDP, and higher taxes equals more revenue, and of course that obviously equates to higher revenue is the result of higher GDP. So too can we add in that lowering taxes equals higher GDP. And thus, we get a direct conclusion. Lower taxes equals more revenue. Now, this isn't a new concept. It has been well observed, and there is an entire curve dedicated to it called the Laffer curve. And as a result, it is why a lot of people argue for cutting taxes when they wish to generate more revenue, because it generates more job growth and thus more stability. Now, in the short term, yes, higher taxes does mean more revenue, but the hit to GDP that causes can very much hamper an economy, so it is often better to avoid it. As such, you want to use other methods. For example, cutting spending. Because sure, it hurts here, but if that cutting of G can finance the growth of I or C, then it's net positive at most, net neutral at minimum, and thus you still win in terms of GDP. And GDP is important as it measures the economic activity of a country through the amount of stuff produced and invested in a year. At least yearly GDP is. And so it does matter. Now, that should not be at the cost of other things such as, standard of living. But as a general rule, because higher GDP means more job growth and opportunities, higher GDP can heavily be correlated with economic success and quality of life. It is why GDP is acknowledged, and specifically per capita GDP, when it comes to standard of living. That'll be all. Have a good one.